Hello and welcome. I'll start by giving a standard YouTube disclaimer, which is that I'm not a financial advisor and this is not financial advice. What I'm here to do is talk about my own experience in crypto, what I've learned or what I think I've learned, and how I intend to approach investing in crypto in 2022. Um, So none of this is to be taken as financial advice, obviously. But hopefully, if you follow along, it might be able to help you. And as I release some more of these videos, you can see how well my approach actually works in real life. I intend to be fairly transparent about the finances that are going in, the results I'm getting, and what I'm looking at to get those results. So firstly, a little bit about my own history. I've been in crypto basically on and off for several years now. I would say more off than on. The first time I got involved was back in about 2016, doing some very light mining, crypto mining, and essentially playing around with some, I guess, trading you could call it at the time, buying into random coins, which at the time basically it was just random coins that people were creating and kind of frenzy of just buying based on who knows what, based on memes, based on anything you could kind of get your hands on to try and buy and sell these things for profit. I left the market at the time because it just didn't seem to have any real value. You had Bitcoin, you had Litecoin, you had a lot of other players, and really it was just everyone creating clones of these coins and putting a new wrapper around it. This was the time that you got things like Dogecoin coming out first, and my experience with really the whole market was that there wasn't much to it. Looking back, definitely I should have bought more Bitcoin, but it was also pre-Ethereum, and it just didn't seem like there was much of a future there. It seemed like that Bitcoin had some utility, but it was really anyone's guess whether it would stick around in the long term. So I left at that point, and I came back in last year at the beginning, I say the end of 2020, beginning of 2021, and really found that the whole experience had changed. It was all about DeFi, and Ethereum had really advanced what crypto could be in a big way, and getting onto some of the DeFi apps at the time, I could see kind of the direction it was heading. And I jumped in and started trading, made some money when the times were good, made some losses when the times were bad. In the end, I got quite impatient. I started doing leverage trading, and really the whole thing went down the drain pretty quickly after that. So after I'd kind of made a bit of money, lost a bit of money, I decided just to take a step back from trading for various reasons. Just it was taking up a lot of my time and mental kind of anxiety, and I felt that I wasn't kind of in the right state of mind to be doing it, given the experience with leverage trading. So from those two experiences, I think I learned a few lessons, um, and really stepping back into trading now at the beginning of 2022, or I should say generally back into crypto and investing. I've been trying to work out a way to take advantage of crypto investing without, while avoiding a lot of those pitfalls that I encountered the first couple of times. So what I'll show you is the strategy that I've produced. And so, starting with the lessons, I think the lessons that I learned, especially from leverage trading, is that the market is volatile and unpredictable in the short term. So no matter how much you think that you can predict what Bitcoin or any other crypto is going to do in the next day, in the next week, you absolutely can't. And you're not going to be able to put into place short-term strategies that rely on the market going one way or another. So my objective in putting together this investment approach is to reduce reliance on market performance. That means when when the market's going well, everyone's doing well, and things are easy. Then the market goes down, everyone's lost money, everyone's panicking. I want to avoid that. I know that the market is going up and down. I want to take advantage of that, take advantage of the volatility, make money essentially off the rise and fall of prices, but not be up when the market is up and not be down when the market is down. So part of that requires being able to take profits often and build my holdings rather than just simply having a hodl bag and then just hoping it kind of goes up. Second assumption there is that from the lesson, as I said, from the growth in between 2016 when I was first in the market and 2020, 2021, I've definitely got the view that crypto is going to continue to grow long term. I think the DeFi and the DApp space, it's obviously if you're the kind of person who's ever gotten your hands on some of these apps and tried to do trading and farming or whatever, you'll realize that these are very valuable systems, and the value is only going to grow over time. And the ceiling on that growth is very, very high. So I don't have any doubt that over the coming years, crypto will become huge. It's already big. It's going to become huge. So really what I'm trying to do here is capitalize on market volatility, continue to make money in the short and the medium term, and build out my long-term investments. So what is my strategy? So I've broken it up into essentially 4 different areas, 4 I guess types of investments. And the key here is understanding what types of investments are profitable at what time and how to funnel money between investments. So let's look at these 4 categories. The first one I've called savings, and essentially this is cash reserves. So as a general rule here, saying cash reserves should be 20 to 60% of my portfolio, basically depending on whether we're in a bear or bull market, whether things are going up, things are going down. The cash reserves can be adjusted as a percentage of total holdings based on the market performance. So what I'm looking at, and I'll go through this in a little bit more detail for each of these different investment types, but I'm looking at Anchor Protocol at the moment. I've been using it for a while, and look, Anchor Protocol delivers 19.5, approximately 20% returns annually. So that is really the baseline. So when you look at these various investment types, that 20% baseline is really the bottom end. So I'm at the very least expecting I'm making 20% returns every year, but of course 20% returns off a kind of a small initial investment is not going to make big bucks long term. It's not really worth it in the long term. So the point of this category of investment is really to provide stability. So that savings is in UST. It's pegged against the US dollar. It's not volatile. It's low risk, low growth. I mean, 20% is still great when you compare it to other savings in the fiat world, but it's not astronomical. So that amount can sit there and accumulate. The next type is investment type is trading. So I categorize this, what I'm calling trading is an amount that basically goes over to a trading platform. I use Binance. You can use whatever you like in the region you're in, whatever is applicable to you. I like Binance because of the interface and the low fees and the fact that you can basically savings holding BNB coin and using the BNB chain. It's a good fit, so that's what I use. But really, you could use anything. And the point here is that you make short to medium term investments based on market fluctuations. So if the market is low, you can buy some coins, some tokens that you think are going to go up, and essentially sell them when they make a profit. And so the target really profit wise, price point wise, is that I'm hoping in trading to exceed this 20% annual growth. So if I can make a 20% short term gain, if I can make a 30% gain or something like this, if I put $100 in, buy, I don't know, Bitcoin, it happens to have a 20% increase. What I do is then take profit. This is a short-term trade. It's not a long-term bag. I'm hoping to take a short-term profit, sell it, and essentially put the money back into savings. The third category here is hodling, and which is, I'm saying, is low risk. As I've said, this is because long term, I believe that crypto is going to only get bigger and bigger. So I think if you choose the right blockchains, the right protocols over a longer period, and now we're talking 1 to 3 years kind of time frame, maybe even longer. If you start building those bags, it becomes a low risk. It could be medium to high growth, and it's a long term proposition. And the last category of investment here, which I've called DEGEN, basically degenerate protocols, of which there are a lot in DeFi. And really, you don't want to go too much more than 10% of your holdings in DEGEN. And what the benefit of this really is, because these other strategies, they will kind of grow. Long term, medium term, you expect to see large rises, but you start with a small investment. If you don't have the ability to keep adding to your position, you don't have a lot of cash to keep adding to your position, you're not going to really grow too much. So these offer some high risk, high growth in the short term. And look, I'll talk a little bit about these later and what I'm looking at and what I'm using. And the point here is to get basically some more capital into your holdings so that you can then invest in kind of the lower risk, higher growth ones. So look, for me, I've got a mortgage, I've got a family. I can't afford to be putting thousands into crypto, no matter how much I believe in it. So this is the approach that I'm following to try and squeeze some more gains really out of what I have. So if you take these four categories together, let's see how they basically relate and how to use them in a downturn. When the market is going down, the prices are low. Essentially, what you want to be doing is transferring out of your savings, so decreasing the 60% down towards 20%, putting it into the trading and essentially the hodling. So you have some money that you've got there to take advantage of the low prices and growth in the medium term, and then dumping some into your long-term bag, essentially to grow in the long term. So that's how you deploy that savings, that cash reserves, and when to deploy it, essentially when the prices are down. This DEGEN strategy, it doesn't rely on the market, and that's really the best thing about it. Is it doesn't matter if the market is doing well, doing poorly, you're always going to get something out of these DEGEN strategies. and you put that back into savings. When the market's low, deploy that out to your trading and your hodling. And when the market is doing well and you've got money in trading, you're essentially, well, you're still pushing your DEGEN out and your savings, and you're then selling and taking gains from your short and medium term trading investments and putting them back into your savings. So basically, if I go backwards a few steps, when the market is low, you buy, say, Bitcoin, whatever your investment is at a low price, it starts going up. You somewhere into that 20+% range, you trade it and you put it back into savings. So that's how you can kind of build this savings, and you can build your HODL bag. So this long-term bag there's no arrows coming out of it. Essentially, the idea is this gets bigger and bigger. You capitalize on the long-term growth of, say, Ethereum or Bitcoin, and at the end of whatever period seems reasonable based on how high this goes, you can then cash out and start doing other things. But this is a very long-term thing. The idea is to build this until it's at a position where you've really made a lot out of this and you can cash out. All right, so I'm going to talk about what I use for these various investment types. So the first one for savings, I use Anchor Protocol, and I have mentioned that. So essentially, Anchor Protocol is built on the Terra Luna blockchain. It offers a 19.48% at the moment. You can see this is very static, usually around 19.5 over a very long term. So for this deposit, $488, I'm going to get 20% of that, which is about $95 over the course of a year. So that's daily 26%. So the benefit here is that you don't have these volatile market fluctuations. You're basically just adding to your position. It's always going to go up. It's always going to go up by 20%. It's pegged to the dollar. It's pretty safe. But the downside is that's not a massive amount of money to be making over the course of the year. So the real purpose of this is to have a cash reserve, and have a cash reserve that is doing something. It's an investment. And when it's time, you can deploy that money where it's going to grow more at a lower risk. So why Anchor Protocol? The reason is this fairly static rate. Really, for me, the reason is its simplicity. I've looked at a lot of other different ways of farming for similar rates, staking for similar rates. Really, there's nothing that offers this level of stability, somewhere around 20%, with this level of ease, without being exposed to just random depreciating farm tokens or other complexity like a lot of these farms and liquidity pools, for example. You'll have entry and exit fees, and you'll have all kinds of things that make the calculation complex. Anchor is very transparent, it's very easy, and it's very simple. It's also based on a reserve, so you're not actually earning extra tokens that fluctuate or anything along those lines. There's no reinvestment costs and periods or anything like that. Essentially, the size of the Anchor reserve grows, and you're free to take money out whenever you like, or put more money in whenever you like. So it's really that simplicity that I appreciate about this system. And so far, I haven't been able to find anything that comes close to the simplicity and the security and really the assurance that Anchor Earn provides. So I highly recommend it. I think in terms of downsides of this, the potential risks, the only one I would really call out is around the value of UST itself, and the fact that it's pegged to the US dollar algorithmically and isn't backed. Look, I'm pretty confident in the way that it's actually done. There's a lot of documentation, a lot of videos on YouTube that you can go and look up and see how UST is actually pegged to the dollar. It seems to me quite safe. It seems to me pretty reasonable, and historically, it's demonstrated that it holds up. But look, that's the risk here in Anchor, is that you've got if you use one platform and one method, you're always exposing yourself to some risk. It's always better to try and maybe pick a couple, diversify. That's just the nature of crypto. When you have all your eggs in one basket, you're open to all sorts of things. It's DeFi. The protocol could fail. They could do a rug pull, all that kind of thing. Obviously, that's not going to happen with Anchor. In terms of the rug pull, I have 100% confidence that won't happen, but you just never know. It's DeFi. It's smart contracts. There could always be a problem. So that's the risk you take, and that's why you get 20%, which is much higher than even I think the stock market averages. Way higher than banks. That's in itself. If you just had money to stick in here, if you weren't sure where this, you didn't want to touch basically crypto investing at all, and you just wanted a savings account, this is the one to go to. It's great. I recommend it. Okay. So moving on to back to the next area, which was trading. So I'm not going to go too much into trading. I use Binance for trading, as I've said. I use it. I enjoy it. I've tried a few other sites. They're all, pretty good. Really comes down to fees and features. There aren't any features that are not on Binance that I want. I don't feel the need to, but use whatever you like. I'll probably put my Binance referral code in the comments. And if you are thinking of signing up, please use the referral code. That would be excellent. So in terms of hodling, there are actually two ways here that I'm doing that, and one of them is using a hardware wallet, which is fine. But lately I've been also checking out this MIDAS investments site, and I'll switch over to that now and show you. So what you need to know about MIDAS essentially is it's a custodial platform. So just like if you're using Binance or Crypto.com or Coinbase or any other custodial platform, you hand over your keys essentially to them. So there are risks in doing it this way. I've done a lot of research on MIDAS. They seem quite established and quite trustworthy. That being said, there's no guarantees here. So you need to do your own risk assessment and see if this is the kind of thing that you want to use. If you do, I'll leave my referral link in the comments. But look, the benefit here is pretty clear. They offer quite a large return for holding your crypto with them. So for Ethereum at the moment, I'm holding some Ethereum. They give you 18% a year on your Ethereum. So if my assumption here is to have a large hodling bag and to build that bag, this is basically another way that I'm doing it. So on top of this whole strategy which I've outlined of trying to make money in the short term off DEGEN investments, in the medium term of crypto fluctuations, putting it back into cash, putting it back into these long-term hodl bags. Basically, here the bag itself just makes another 18%. So every year this grows by 18%. There's nowhere else from MIDAS that lets you do that. They have very generous, very high APYs, APRs on a lot of different assets. You could even do 20% on your USDT, which is basically the same rate as I'm getting in Anchor. I don't like to put all my eggs in one basket, which is why I'm not just using this for everything. I'm also using Terra's Anchor protocol. It's also a little bit higher risk again, given that it is custodial. They have Basically, they have the keys. They can, if they were to disappear off the face of the earth, they could take all this with them. So it's use at your own risk kind of deal. I definitely would be reluctant to put too much into this platform as it stands, just because of the risk. But they are really taking steps, following their social media and their activity. They're really taking steps to try and increase the level of confidence with them, um, including KYC and other measures to try and make them a little bit more appealing and appear a little bit more safe. So at the moment, I'm using them. You see some growth here in the Ethereum holdings. I know I've got just low balances here, but I like the product. That's about all I really say on MIDAS. And let's talk about the final category, which is DEGEN. And I'll show you what I'm using at the moment, being TITANO, Stable One, and MATICSTAKER. But there are hundreds, maybe thousands. And the thing about these DEGEN protocols is they're not sustainable, and don't pretend that they're sustainable. A lot of people think they are. A lot of people, or at least say on the internet that they think they are, that they're going to be in them for the long term, and they're only going to grow over years and years. If you look at the way that they're built, if you look at the tokenomics, if you look at the way they're coded, it's definitely not the case. But where I think there's opportunity is in the short term. You can kind of get in, get out within a certain time frame, and you can make basically a lot more than you would just trading and doing other things. So this is where you can kind of double your money. This is where you can 3, 4, 5x your money, depending on which protocol you get into and what kind of time frame, how early you are, and how lucky you are, really. But this is high risk. So I'd expect, if I'm doing, say, 3 to 5 different protocols, as I said, I'm kind of targeting around 10% of my total holdings, so kind of a very low overall. I split them in between 3 or 5. So if I'm investing in, say, 3 of these or 5 of these, let's say 5, I could reasonably expect, say, 2 of those to fail, to be a rug pull, to lose my money. It's just being at the wrong time. Whatever reason, it doesn't work out. And I'm hoping that, say, the 2 or 3 out of 5 that do work out are enough to compensate me more, in the positive. So again, I'm trying to get higher than 20-30% yield out of these, and really hoping for something closer to about 100% on most of them. That's just how they work and how they're set up. So again, I wouldn't be relying on this. I wouldn't be putting a lot of money into this unless you're just kind of gambling. But I think as a small part of a portfolio, they're interesting. And if you kind of get in, get out in the short term, you can make money. So I'll show you what I've been looking at in those 3. So TITANO is the first one, and really you can see I've got very small amount of money in there. But essentially, the way TITANO works is that you put in a deposit, you automatically lose 13% of that deposit on purchase, and then you lose another 18% on the sell. So in the meantime, you get a daily return on investment of $190. So that works out somewhere to about a 2-week or so break-even period, assuming the price is pretty stable. And then beyond that, it starts getting higher. So within a month, you may have somewhere close to doubling your money, and a couple of months, it continues to climb. Over the course of a year, you have an API of 102,000%. And this is what I'm talking about in terms of long-term viability of these platforms not being there. Obviously, you cannot get $102,000 return on investment. They create more TITANO tokens, and at some point, the price gets way beyond essentially the demand, because you're just dumping, creating more and more tokens, and the demand is just dropping as the value of those tokens drop. So the tricky thing is just trying to work out when is the right time to exit. I think at this point I'm pretty much exactly on the break-even point, so I'm essentially waiting for either a price spike or some other trigger to get out of TITANO, hopefully with a little bit of profit, and that's what I'm going for here. There are others, Libero and others, I believe, that are forks that work in a similar way. But as I said, if you think this is a long-term stable platform, then you're going to be in for a shock. But in the short term, even with when you have these kind of clear, essentially unsustainable platforms in the long term, it seems like you can make some money in the short term. Is why I'm here. The next one is Stable One, which I've just recently invested in, and I'm giving this a go with not too much investment. But essentially, what happens here is not too different from TITANO, I guess. Well, whereas TITANO, you can get your initial investment out. In Stable One, you're putting in an initial investment which you cannot get out ever, and then you get 7% of that investment every day, with some component of that 7% going back into reinvest. And essentially, what you're doing is you're getting you're getting a return on investment over time. And look, I should say all of these are just Ponzi schemes. There's no money coming into them from anywhere else. You put in your investment, you start getting a regular payout, but when people stop investing, it all just falls over essentially, and no one gets paid anymore. So that's just how it works. So it's the gamble here is, can I get my investment out with a profit before the whole thing falls over? That's basically what I'm gambling, and I think they should be sustainable really for a reasonable period of time, a few months at least. I don't think it's going to fall over in a few weeks. So I think for a little while, it's probably worthwhile and feasible to just use them. So the third one here is MATICSTAKER, and this is like about this one is really its simplicity. And I first invested in this a couple of weeks ago, thinking, well, it's going to be a complete scam. The site looks awful. These different packages don't really make much logical sense when you think about it. Why is the return rate much higher per day on a short-term deposit than a long-term deposit? It doesn't really make much sense. Why wouldn't I just do 2 short-term deposits and make basically 450% ROI rather than 370 for the same time period? So none of this makes any sense. It's poorly designed. But I put in I think 23 Matic, and I waited 2 weeks, and when I cashed out, I was able to withdraw twice the Matic I put in. So that was good. In the meantime, the daily earnings have gone up to 16%. I think they were about 9%. The ROI, look, that's a ridiculous ROI. So I thought, look, let's invest 24 Matic in there. If I can get 160 Matic out, then that is a massive return on investment. It's going to be worth the risk. I've done it once successfully. I'm gonna try it again. So let's see. Again, what I like about this is the simplicity of just you deposit, what's going to come out, and there is a 10% fee, I think, on that 160 Matic. So regardless, it is I think, what is that about it? 6 times my original investment, which is 600% return is pretty high. So those are the 3 that I'm looking at. As I said, there are others. I've heard about others like Tomb Finance and all the various forks, and all sorts of other degenerate farming methods. I've tried out some of these liquidity pools with really high yields, and I haven't enjoyed the experience, to be honest. I think a lot of these these higher yields are only there on paper. You get a coin that just crashes in price, and you don't really get much value out of them in the long term for a lot of these farms. For things like Tomb Finance and similar, I don't like really the complexity. It seems there just to hide what the nature of the protocol is. Those are the kinds of ones where you buy a token, and then you take the token and you put it into another farm, and then you get another token, and then you wrap that token in something else and reinvest it somewhere else. Like that's a lot of just clicking around and doing pointless things for no reason. It's really just to hide. To me, it seems like it's there to hide what you're actually investing in and for no real benefit. So again, the things I appreciate about these ones is they're pretty simple, pretty transparent. I know that they're Ponzi schemes. I know that they're not long-term sustainable, but maybe I can make some money off them in the short term. And I think the trick with following these DEGEN strategies is to do them for a little bit when they're new, and then get out. As long as they go on, the less they are going to be sustainable. So I'm on the lookout for new ones, and yeah, that's back to my real strategy. That's essentially how I intend to grow my investment, taking profits from DEGEN, putting into savings when the market is down, putting that money into the trading, putting some into the hodl bags, and then when the market is up, selling for short-term gain, putting them back into savings. I think that's a pretty good strategy. I'm going to try it for a while and see how it goes. I'll give you regular updates on this channel when I'm either looking at a new protocol, or when I'm you know, doing a sale or something that I think is interesting, or some interesting research, or just to give you an update. So just to talk about my own portfolio and what my holdings are at the moment. Again, as I said at the outset, I want to be very transparent, and that's part of the point of this channel, is to actually see how things work in the real world, not just in theory, as a lot of people talk about. Not theoretical. This is real world. So look, this is a very small amount invested, and that's on purpose. I do intend to increase my investment, but as I also said, I've I've got a family, I've got a mortgage. I can't just be pumping a lot of money into crypto. So I'm going to try and grow this through the strategy that I've outlined, as well as putting whatever I can into this. And hopefully, as the months and years go by, we'll be able to see some good growth on this portfolio. But at the moment, you can see I've got about 60% sitting on the Anchor protocol, about 6% trading, which is in this Elrond coin, which I purchased at absolutely the wrong time, and it's dropped now to I guess like 40% since the point I bought it. So already that hasn't been a good sign for trading. But let's hold tight, see when I can get up to a profit point on this investment, and then just sell for a small profit, and then move on. In my hodl bag at the moment, I just have some ETH in MIDAS, which has also dropped in value, but this is a long-term bag, so it shouldn't really matter what the short-term fluctuations are. I'm thinking more what is the price going to be in a couple of years' time. And then the 3 DEGEN strategies, which are a little bit over my 10%, which I've got as a target for these DEGENs. But look, they're fun, they're interesting, and I'm hoping to make a little bit of money out of those in the short term. So we'll see how that goes. So that's it for the video. Thanks everyone for watching, and I hope to see you soon.